This video will go through depreciation, provisions and reserves, including definitions, techniques, impact on financial accounts, and important in decision making. Depreciation is a fundamental accounting and financial concept that is essential to understand how to calculate an asset's true value over time. Understanding depreciation is important whether you are a business owner, investor, or simply interested in money matters. Depreciation is the methodical distribution of a tangible asset's purchase price over the period of its useful life. Items like machinery, vehicles, buildings, and equipment are examples of tangible assets. It represents how these assets depreciate, become obsolete, or lose value as a result of being employed in corporate activities. Several methods are used to calculate depreciation, each with its own set of rules and benefits. The most common depreciation method include straight line depreciation. This method evenly distributes the asset's cost over its useful life. The formula for straight line depreciation is depreciation expense is equal to cost of asset minus salvage value divided by useful life. Declining balance depreciation. It is also known as accelerated depreciation. This method allows for higher depreciation expenses in the early years of an asset's life and lower expenses in later years. It is often used for assets that lose value more quickly. Units of production depreciation. This method allocates depreciation based on the number of units an asset produces of the number of hours it is used. It is especially useful for assets like manufacturing equipment. Sum of the year's digits, SYD depreciation. SYD depreciation accelerates depreciation expenses by taking the sum of the years of an asset's useful life as the denominator for the depreciation fraction. Depreciation has significant effects on a company's financial statements. Depreciation expense reduces a company's net income. This reduction reflects the cost of using assets to generate revenue. A lower net income may also result in lower income tax liabilities. The accumulated depreciation account on the balance sheet represents the total depreciation expense recognized over the asset's life. The net book value of the asset, cost minus accumulated depreciation, reflects its remaining value. Depreciation is a non-cash expense, so it is added back to net income when calculating cash flow from operations. This adjustment is important for assessing a company's actual cash position. Depreciation plays a crucial role in various business decisions. When evaluating investments in new assets, businesses consider depreciation to determine the asset's total cost and its impact on future cash flows. Investors and creditors assess a company's financial health by examining its depreciation policies and the age and condition of its assets. Depreciation can have a significant impact on a company's tax liability. Proper tax planning can optimize tax deductions related to depreciations. Depreciation is an important accounting concept that assists companies in properly allocating the cost of assets over time and reflecting their true value. Effective financial management requires a thorough understanding of depreciation processes, their effects on financial statements, and their function in decision making. A thorough understanding of depreciation will help you make sound financial choices, whether you are a business owner or an investor. Let us now talk about provisions and reserves. Provisions and reserves are important accounting concepts that serve different purposes in financial reporting. They are used by businesses to set aside funds for various contingencies and obligations. Provisions are liabilities that a company recognizes on its balance sheet to account for anticipated future expenses or losses. They are created when there is a present obligation, either legal or constructive, resulting from past events, and it is possible that an outflow of economic resources will be required to settle that obligation. Provisions are typically recognized in accordance with accounting standards and are associated with specific events or uncertainties. Companies estimate the amount of receivables that may not be collected due to customer defaults and create a provision for bad debts. Businesses set aside funds to cover the cost of honoring warranties on their products. Companies create provisions when they are involved in legal disputes or claims, and it is likely that they will have to pay damages or settlements. When a company plans to restructure its operations, it may create provisions for costs associated with employee layoffs or asset impairments. Provisions are recognized as expenses on the income statement, reducing the company's reported profit for the period. Reserves, on the other hand, are appropriations of a company's retained earnings or other equity accounts. They are not created in response to specific events or obligations, but are used to set aside a portion of a company's profit for general or unspecified purposes. Reserves are not recognized as liabilities on the balance sheet, but rather as part of the equity section. Companies may establish contingency reserves to cover unforeseen expenses or economic downturns. These reserves are used to maintain a stable dividend payout, ensuring that dividends to shareholders remain consistent even during periods of lower profit. These reserves are used to record any surplus arising from capital transactions, such as the revaluation of assets. Provisions are recognized liabilities reflecting specific obligations or anticipated losses. Reserves are appropriations of retained earnings representing general or unspecified purposes. Provisions are recognized when there is a probable future outflow of economic resources, while reserves are created at the discretion of the company's management. Provisions are expensed on the income statement, reducing reported profits. Reserves do not impact the income statement, but are reflected in the equity section of the balance sheet. Provisions are set aside for specific known obligations or contingencies. Reserves are established for general financial management or as a means of distributing profits. Reserves and provisions have different functions in financial accounting. The income statement is affected by provisions, which are recognized liabilities used to account for specified obligations and anticipated losses. On the contrary, reserves indicate allocations of equity for undefined or broad purposes and have no impact on profit or loss. For proper financial reporting and decision making, it is important to understand the distinctions between these two accounting principles. Thanks.